All right, what's going on? I am here with Ashlyn. Today we're going to be doing a webinar, "The Truth About Annuities." Welcome. So this is going to be interesting, Ashlyn. So one of the things that we talk about with annuities is that Wall Street billionaires don't worry about running out of money, but the average person does. All right. So as we talk about annuities here, a couple things that we want to remember: annuities are not for everybody. However, most people already own an annuity, and that annuity is called Social Security, right? So whether you know it or not, you already have an annuity. And the thing is, too, annuities are becoming more and more popular. Year over year, we've seen a 12% year over year increase in sales. Why do we see that? A couple of things. Number one, people are hungry for and they're craving income buffers for their retirement. They're craving guarantees. They've spent, 30 working years or maybe 40 working years building up their net worth and building up their resources. And now it's time to retire. And they want to have their income protected or have a portion of their nest egg protected, right? So they're craving those income buffers, or they're craving those guarantees, at least with a part of their portfolio. Now, annuities are not a four-letter word, regardless of what the Wall Street industry would have you believe. At the end of the day, you got to kind of think about who are you getting your advice from, right? Like if you're talking to a stockbroker where that's what they do and that's how they get paid, they sell stocks and they make a commission. Of course, they're going to tell you not to do an annuity because that is competition for what they offer or what they're trying to sell. If you're talking to a Wall Street money management firm where that's all they do is they manage wealth as far as like stocks and bonds, it's like they're going to try to tell you a bunch of bad stuff about annuities. Why? Because that's competition for what it is that they do. Okay. Um, so that's what you have to take into consideration. Some of the other like talking heads that are out there, people who are not financial advisors, but who are like influencers or media people, whether it's Susie Orman, whether it's Dave Ramsey, when they're sponsored by Wall Street or they're sponsored by mutual funds, like what kind of advice do you think that you're going to get there? Is it going to be fair? Is it going to be non-biased? Like that's the thing that you need to take into consideration. But me, Ron Sneller, I am an independent fiduciary advisor. I'm required by law to act in the best interest of the clients. So that's what we're going to do today is we're going to talk about the truth about annuities. What are the pros? What are the cons? Where do they make sense? When would they not maybe make sense? And if you're going to implement an annuity, like how much of your money should go there, or like what percentage of your portfolio should end up going into an annuity. So that's what we're here to do, to separate fact from fiction, to give you the cold hard truth, to give you the good, to give you the bad, and that's what we're all about here at Sneller Financial. So, kind of moving on here. Um, the the problem I think also is not annuities, but how they're sold by some salespeople. They can be a great tool in the toolbox, but the problem many salespeople say is, "Oh, let's put all your money into an annuity," and that's where you're kind of looking at that other end of the spectrum, where maybe a Wall Street brokerage firm will say annuities are bad, don't put any money there. But if you're talking with somebody who works for a life insurance company or an annuity company, they may try to get you to put all of your money there, and that's not the right thing to do, probably either, right? So, like many things in life, the truth here is in the middle, right? So that's the thing that you also have to consider, and that's the thing that you have to think about, right? So let's kind of start out by talking about the different types of annuities. There's four main types. We're going to talk about like a fixed annuity, or sometimes they're called multi-year guarantee annuities, or they're abbreviated MYGAs, MYGA. And that's kind of like the insurance world's version of a CD. So there's the MYGAs, or a fixed annuity. There's the fixed indexed annuities. There are guaranteed income annuities, which could be your SPIAs or your DIAs. And then there are variable annuities, right, that are invested in the market. So just let's circle back. Let's talk about multi-year guarantee annuities. Very, very simple here, right? They're like the insurance world's version of a CD, but usually a little bit better in as much as they usually offer a little bit better interest. When I compare these MYGAs to a bank CD, usually the MYGAs are offering between a quarter to a 0.5% more interest on similar terms, whether we're looking at a 3-year CD versus a 3-year MYGA, whether we're looking at a 5-year CD versus a 5-year MYGA. So usually with the MYGAs, Again, multi-year guarantee annuities, usually a little bit better interest, which is good. But the other thing with the MIGAs is with the insurance product there is that they're actually tax deferred. Unlike a CD that you get from a bank where you have to pay tax on the interest every year as you earn it. With the insurance version, with these MIGAs, you do not pay tax every year. You only pay tax at the end. So a lot of people like the tax deferral as well. So MIGAs are pretty simple. Next up are fixed index annuities. And what fixed index annuities are, when you put your money into the annuity, the insurance company, they link your money to the performance of an external stock market index. And usually it's going to be something like the S&P 500. And what they're doing is they're giving you complete downside protection. So a 0% floor, meaning that if the market goes down, you don't lose any money. You just get zero for the year. But in the years where the market goes up, you'll participate in that market upside up to a specific cap or up to a certain participation rate and kind of share in the profitability with the insurance company on that. So with a lot of clients that we've been working with recently, we've got them these fixed index annuities where for the next year, they have a 10.1% cap, meaning if the S&P 500 goes up 8%, they get all 8. If it goes up 10, they get 10. If the S&P goes up 12%, they're capped out at 10.1. But what's the trade-off? The trade-off is if the market goes down 25%, they don't lose a dime of their principal, right? So it's one of those like middle of the road, like complete downside protection, some pretty good upside potential as well. So some people like that. Now, the caveat to that, because some people say, well, that sounds too good to be true. Give me complete downside protection and give me upside up to 10%. The thing that's too good to be true is that this is not done on a short-term basis, right? Because the insurance company, they don't know when the market's going to go down versus when the market's going to go up. But what they are doing is they're simply playing long-term averages. They know that over a 10-year period, on average, the market's going to go down 2 or 3 years. And during that time, they're going to have to protect you. But the other 7 or 8 years, the market's going to go up. And during those years, even though they have to share some of that profitability with you or share some of those profits with you in the form of interest crediting, they'll also make enough money over that period of time where they will be profitable and they'll make money. But in order to do this is called index hedging. In order to do this, the insurance company does need a long-term commitment. And so a lot of these index annuities, they have a 7-year commitment or a 10-year commitment. And if you pull your money out early, you're assessed with the surrender charge, right? Because think about it. The insurance company, again, they don't know when the market's going to go up or down. They're just playing long-term averages. But if you don't have any kind of commitment to them, and if you could just pull your money out whenever you wanted, especially let's say in your particular 10-year cycle, if the market went down a couple points in the beginning, the first 2 years, and then if you could just quit with no ramifications, you would leave the insurance company holding the bag, which means that they're going to lose money. And let's face it, guys, insurance companies are not in the business of losing money, right? So in order to make that work, they need your partnership for a long-term period. And the longer that you're willing to commit, the higher the participation rates are and the higher that the caps are going to be. I don't have anybody in these longer 14 or 15-year surrender charge policies. I find that the sweet spot is 10. That's going to give you pretty good upside potential, but without, kind of locking you in for too long. And the other thing too is with these fixed index annuities, your money's not locked up like some people would have you believe. There are liquidity provisions there. Generally speaking, you can access 10% of your money per year. So if you put $200,000 into one of these fixed index annuities a year from now, if you needed $20,000, if you needed 10%, you could access $20,000 without any kind of penalties or surrender charges. But that's a thing that you want to remember when implementing one of these fixed index annuities. They have a lot of great benefits. However, you have to understand that they're more of a long-term type commitment, right? So we've talked about MIGAs, we've talked about fixed index annuities, and I use fixed index annuities with some of my clients. Same thing, I've used MIGAs with some of my clients. The thing that the product that I use the most though would be number 3, which are guaranteed income annuities. Guaranteed income annuities. And the reason that I use these, and we'll talk more about these in depth during this webinar, is just because they function like a pension. And we all know that pensions have gone extinct. It's pretty much the way of the dinosaurs, right? It's less than 15% of public sector workers have pensions anymore. So it's not like my parents and maybe our grandparents where they retired on pensions and they had a consistent paycheck coming in every month for the rest of their life. I mean, those are pretty much gone, right? As the 401k came out, what these companies have done is they have shifted all of the risk from the company, they've shifted it onto the individual investor through the 401k. And so now you have to make sure that you save enough, and you need to manage the money, and you need to manage the market risk. And unfortunately, most people are failing at doing that, being able to save enough money, being able to manage that risk and take the retirement income. So that's what I think is the greatest benefit of using annuities, is to replicate these pensions, right? And within that guaranteed income scenario, within those guaranteed income annuities, there's really kind of like two types. You may hear the term SPIA, and that stands for single premium immediate annuity. That just means that we're helping a guy right now. He's retiring on September 11th. He just rolled over $1 million. We're going to be turning on the income right away. He and his wife are 65. And so that's going to give them a 7.2% pension payout rate, meaning that that pension is going to be $72,000 per year. So that's an immediate annuity for their ages and for their time horizon, a 7.2% pension payout rate. They put in $1 million. That means that they're going to get $72,000 per year for the rest of their lives, even if they live to age 100. And even if they spend all of the capital, even if they spend the entire $1 million, if one of the two is still alive when that happens, when their account balance hits zero, now they're spending the insurance company's money. They're taking out $72,000 for the rest of their lives. Again, even if they live to age 100. And so that's one of the nice things to remove longevity risk and remove market risk and create a guaranteed lifetime pension. Now, with this particular couple, that's only about 25 or 30% of their overall assets that we put into the annuity, but they wanted to increase the income floor. And we'll talk more about that, right? But the other type of a guaranteed income annuity is called a DIA, or a deferred income annuity, meaning that people are planning in advance, right? Meaning that maybe they roll their money over and establish the annuity maybe 3 years before they actually retire. So they're planning in advance. And the benefit of doing a deferred income annuity and planning in advance is that it increases your pension payout rate. So instead of maybe getting a 7% pension payout rate, you could get an 8% or 9%. So it depends on your age and it depends on your deferral period. But in this same scenario, if this person would have rolled over the $1 million and had a 2-year deferral period and took the income after 2 years, their pension payout rate would have been about 8.5%, meaning the pension would be about $85,000 per year. So that's the difference when you hear SPIA versus DIA. All that means is an immediate annuity versus one where we're planning in advance and we're going to be deferring the income for a few years, and that can increase your pension income. And for some people, sometimes that sounds a little bit confusing, but you already have something that works very, very similar. And that something is called Social Security, right? Because we're all eligible for Social Security at age 62. But if we take it at 62, it's going to be as low as possible. But for each year that we delay past 62, that Social Security income goes up 7 or 8% for each year that we delay, up till 70. With Social Security, you don't get any benefits for delaying further past 70. But we do have the deferral period there. So similar to how Social Security works, the longer that you wait, the more income that you're going to have. And then finally, the fourth main type of annuity is called a variable annuity. And variable annuities are annuities that are invested in the stock market. So they're going to have a lower guaranteed income floor, and they're going to have maybe a higher growth potential. But some of the problems with variable annuities is that the money is in the market and it is at risk, and variable annuities, they can lose value. And I've seen many variable annuities that do and have lost value. And for that reason, I personally do not use variable annuities in my practice. Now, I'm not going to be one of those guys who are going to say, oh, all variable annuities are bad. No, there are no financial products that are bad. All financial products exist for a specific reason. And if there were any financial products that were truly bad, regulators wouldn't even allow them to be on the market or in the marketplace, right? It's just with my philosophy and my planning methodologies, what I like to do, variable annuities just don't fit for me. I use annuities because I want safety. I want guarantees, whether it's, a guaranteed floor or a guaranteed level of income. And so variable annuities, they can be good during the accumulation phase of your life. And there's been a few times where as people have got closer to retirement, they come to me, they have old variable annuities and they just don't want that risk anymore. And they want higher guarantees. And we'll roll it over and replace it with like a guaranteed income annuity that has higher floors and more guarantees as they're getting ready to enter this retirement distribution phase of their lives, right? So again, those are the four main types of annuities. There's the multi-year guarantee annuities, or MIGAs. There's fixed index annuities. There are the guaranteed income annuities, which can be SPIAs or DIAs, and then there's variable annuities as well. Right. So what I mostly focus on in my practice is I specialize in helping people transition into the retirement income phase of their life. So we often utilize an annuity to create an income floor to protect the necessities. And then we utilize stocks and bonds for other discretionary expenses. But the reason I'm so passionate about using annuities to create this income floor is that all the retirement research that has been done is very, very clear. Retirees who have annuities, who have this guaranteed income, they actually spend twice as much in retirement when they have annuities versus people who don't. And we all know that money is an emotional topic, in that investing also is very emotional. We call that behavioral finance. And part of the reason why people who spend so much more money and I would probably think enjoy their retirement more when they have annuity is this, because when people end up retiring, they're entering this world of the unknown, right? For the last 35 years of their life, they've had a steady paycheck and they've built up a certain amount in their 401ks or their investment accounts. 401k specialist. This is like 2019. These are a couple of researchers and professors at the American College of Financial Services. Michael Finca on the left there heads up the wealth management division, and Wade Pfau on the right heads up the retirement income planning. In 2019, they were talking about this, getting annuities in 401ks. And that's a change that actually has just been made here recently within the last year, where now you can select these guaranteed income annuities within your 401k as an investment option. Because again, so many people are craving that guaranteed retirement income, craving those pensions, and your 401k doesn't act like that. But you can make your 401k act like that by simply moving some of the money into an annuity. Again, I'm not talking about moving all of it there. We're talking about moving a portion of it there. Okay. And what portion that might be, it's going to be different for each individual client's scenario as far as their age and how much income they want and their time horizon and their risk tolerance. So again, nothing that we're talking about today is going to be personalized financial advice, but it's more education. All right. So what we're actually looking for here, guys, as we continue our conversation about annuities, again, it's really about longevity planning. It's really about risk management. And so what we're looking for with the annuities, we're looking for guarantees, guys. We're looking for guarantees that Wall Street products can't provide. Okay. I think one of the interesting things is a lot of people have been taught that they want to use bonds in their portfolio to diversify. Bonds tend to move differently than stocks, and they tend to not be as volatile. However, bonds are securities. Bonds can and do lose value. And what's really interesting, if you look out over the last 5 years, coming out of COVID, right, and how scary that was in the financial markets, coming out of COVID, if you would have bought long-term treasury bonds, 20-year treasury bonds 5 years ago, how have you done? Well, that part of your portfolio is down almost 50%. You've lost almost half of your value if you've bought long-term treasury bonds. And the reason why is because bonds are inversely proportional to interest rates. As interest rates goes up, like they have over the last few years, as interest rates go up, bond prices go down, right? So a lot of people who have used bonds in their portfolio, they've actually lost money over the last 5 years. And really, bonds have not been a good long-term investment. This is just my opinion. Bonds have not been a good long-term investment for more than 20 years, since before 2008, because of what they've done with interest rates, how they've artificially manipulated interest rates so much coming out of the great financial crisis. So bonds have not been a good investment for quite a long time. And so a lot of times we'll use annuities as a bond substitute. And there's some other things we do as well with, structured notes and treasuries and buffered ETFs and things. But annuities, they're an amazing retirement income tool, right? And so when we're using annuities, we're looking at four things: either guaranteed protection of principal, where it can't go down due to a market downturn, guaranteed lifetime income, like that longevity element, where we're talking about those guaranteed income annuities, guaranteed death benefit, or other times people are thinking legacy planning. A lot of times people are thinking, you know what, we're going to spend the annuity and we're going to leave the other assets or the other investments to the children. Like we're going to put enough money into the annuity together with our Social Security, and if we have a pension, to create our baseline level of income. Our goal is not to touch the investment portfolio, maybe for emergencies or once in a while trips or something, but pretty much leave that alone, let that grow. We leave that to the kids, right? So that's another thing that they can do. What are some of the things that I see go wrong with annuities? Again, it's sales practices. A lot of sales people out there, they lead with these misleading bonuses. They say, "Oh, you get a 10% bonus." Well, here's the thing: you can't walk away with that. What it is, it's a roll up rate, meaning like once you move the annuity over for each year you delay income, maybe the income increases 10%. Right. We talked earlier, like for Social Security, you're eligible at age 62, but each year you delay, the Social Security income goes up 8%. But with these bonuses, you can't walk away with them as liquid cash, right? Some of the annuities that I use for people, they do have bonuses, and I rarely talk about them. Why? Because at the end of the day, it doesn't matter. It's not liquid cash, right? What I really care about is the company that I'm shopping around with, the company that I'm placing the annuity with. What's going to be the highest level of pension income? Who has the most pension income when we go to turn the pension on? Like the bonus is really just part of an internal calculation. To me, it's a little bit of smoke and mirrors. But that's one of the things that I do see go wrong are people like hyping up things and kind of misleading prospects and clients as to how they work, right? Again, the fixed index annuities can also, I mentioned, be a good replacement for bonds because you can potentially get a bond like return, but with no market risk of bonds. That would be an index annuity for accumulation. Again, I mentioned earlier, we've got clients annuities with a 10.1% cap recently, meaning that in a good market year, they can get as high as 10.1%. If the market goes down, they don't lose any money. They just get zero interest credit for that year. Now, that doesn't mean that that annuity is going to average 10.1% over a 10-year period because there will be a few years in there where the annuity gets zero, right? And that'll bring down the average. What's likely to happen with these index annuities is over a long-term period, over a long time horizon, they're likely to average somewhere between 4 to 6%, which is a bond-like return. But guess what? No risk of bonds. Remember, we just talked about that over the last 5 years, bonds have lost money. And the longer duration you held, the more money you lost with those bonds. Okay. And the other thing, too, about these fixed index annuities, these are the lowest cost annuities because many of the fixed index annuities, they have no fees at all, right? They have no fees at all. And that's another problem, too, I do see in the industry with financial advisors or insurance agents. When they sell an annuity, they'll add on all these extras, like these different riders and things that maybe aren't necessary, and they come with extra fees and they eat into the returns, right? Really, the only rider that I use are on the guaranteed income annuities. We're putting a rider on there. And what the rider does, and usually it's between 1 to 1.2%. But what the rider does, you're paying for the privilege of turning it into a lifetime pension, right? Because without that, like if you spend your account down to zero, like you're just out of income, you're done, right? But with the guaranteed incomes annuities, they have like this rider built into it, which gives it the guaranteed income characteristic that we're looking for, right? And so the pension income that's quoted, like let's say $6,000 a month of pension income, that will be net of any of those rider fees, right? So again, when you're buying an annuity, you got to be really careful as to what you're purchasing and understand like how is it going to fit in your portfolio. So some advisors hate annuities, some love annuities. Again, I'm just in the middle of the road, kind of depending on where the planning tells us that we should go. Okay. Next thing I think that's worth covering is how much we should put into the annuity. Again, this has just been my experience with clients. We're popping up an article here from JP Morgan Asset Management. They say annuities are an essential slice of the retirement pie, not the whole pie, but they say that annuities should be included as a part of it because investors need diversification. They also need annuitization, right? But as far as how much, what I have found with my clients, we can get the job done using between 20 to 40% of an annuity, or excuse me, 20 to 40% of their portfolio into an annuity, right? So that might look like something if somebody came to me with $1 million, maybe 250,000 to 300,000, that gets rolled over to an insurance company to create one of these guaranteed income annuities to create a pension. And what that's going to do is it's going to remove the strain on the investment portfolio to create the retirement income. And then the other 700,000 we have left invested in the market. And one of the cool things that I like as a wealth manager with that remaining $700,000, because the annuity is now doing the job of the heavy lifting to create retirement income, guess what? The $700,000 that we have invested, it can stay invested more aggressively than a retiree normally would, right? There's a lot of retirees where their investment portfolio, I've got them in 80% stocks and only 20% fixed income because we've got an income annuity. And the income annuity is serving as a bond alternative, but annuities do a better job than bonds, at least in this interest rate environment. They do a better job than bonds of creating retirement income, right? And actually giving you absolute guarantees. So I find that that's very, very helpful. And so with one of these income annuities, too, your objective should be to outlive your capital, right? Because people say, well, what about the survivor benefits? If I put money into an annuity, there's not going to be anything left for my spouse or kids. And that's not necessarily true. The annuities that we use, let's say that you roll over money from your IRA, you start an annuity, and let's say you die a year into retirement. Okay. God forbid you're out for a walk and you get hit by a bus or something, right? Well, if you're married, we have a 100% spousal continuation benefit, right? So that means your spouse is just going to take over that pension. There's going to be no reduction. It's a 100% spousal continuation benefit. And then she's going to take that pension for the rest of her life, right? Now, when she dies, hopefully a long time away, but when she dies, if you put, let's say, 300,000 into an annuity, if she hasn't spent all 300,000 of capital yet, any remaining principal is then going to go to your kids. So these annuities that we use, these income annuities, do have survivor benefits, right? But my goal is not to leave anything on from the annuity. My goal is to leave on money from the investment portfolio. With these income annuities, our goal is to spend our capital down to zero. That's the objective. You want to outlive your capital, drain your annuity down to zero, but I want you to still be alive, right? And then what we do is we're starting to spend the insurance company's capital because we're taking money from the risk pool, right? So in this instance, we might put $300,000 into an annuity, and if we live into our 90s, maybe we pull out $700,000 or $800,000 of actual income that we've been spending all during that time. Right. So that's the goal there. With the annuity, you want to spend it down to zero, because even if your account balance hits zero, the income never stops. Try doing that with your investment portfolio, or try doing that with your 401k, your traditional 401ks. If you spend it down to zero, you're out of income and you're done, right? Like, you're out of money. And that is every retiree's number one biggest fear, is running out of money before running out of life. All the surveys out there show that's the retiree's number one biggest fear. Again, Wall Street brokers and billionaires, they don't worry about running out of money, but the average American does, right? And that's where having these annuities as part of your plan. Again, I have found a lot of success with 20 to 40%. And using it just as a bond substitute, it makes a lot of sense, and can really be helpful for, number one, for the actual numbers as far as how the retirement income plan works, but also from a client's mind, their mindset, just the peace of mind, that behavioral finance, when markets get wonky and they get volatile, they're not necessarily calling me up all worried, because although maybe their portfolio has come down 10%, their income hasn't dropped a dime, and they know that their income is going to be unaffected. Right. Let's take a look at something that Michael Finka says here. He actually says that economists are baffled by people who don't want to use annuities. And again, a lot of this is just bad advice or just brainwashing from like the Wall Street or like the brokerage firms. Right. But what Michael Finka says is that you could either keep doing what you're doing, just invest in stocks and bonds, and it's going to be a riskier retirement and it will cost you more. Or you could put some money into an annuity, which is going to mean that you have a safer retirement and it's going to cost you less. Now, what does he mean by that? Like, the cost on it? Well, you gotta stop and think. When you're doing your retirement income, if you keep all of your money in stocks and bonds, you got to think, all right, I don't know exactly what the market's going to do. I need to pace myself throughout all the ups and downs in the market, because I got to make sure this money lasts. How do I know how much of my portfolio I'm able to spend? Like, if I have $1 million of capital, if I retire with $1 million, how much am I able to spend? Thankfully, the financial services industry has done all that research for you. We have 100 years of rolling stock and bond market data all through all the ups and downs of the market. And the financial services industry has established what's called the safe withdrawal rule, or the safe withdrawal rate, meaning that throughout all the ups and downs during the bad markets, that if you pace yourself and if you take out 4% of your retirement portfolio, 4%, that gives you a very high likelihood of not running out of money. Meaning, let's say you retire at 65, you got $1 million. You can take out 4%. If you want to be safe, 4%. That means you get $40,000 a year. And then the next year you can take out a little bit more because it's adjusted for inflation. So maybe it'll be like 41,000 or 40,500, right? So, but 4%, that's $40,000 a year. With annuities, again, it's going to depend on your age and whether you're deferring the income or not, whether it's an immediate annuity or a deferred annuity. With annuities, guess what? On average, we're getting 8% payout rates for clients. If they put $1 million into an annuity, they're going to get an $80,000 a year income. Why? Because there's no market risk, right? If you keep money in stocks and bonds, you have to mitigate and pace yourself for the market volatility and the market risk. With guaranteed income annuities, there is no market risk, right? So in that case, if you put $1 million into one of these annuities, if it's paying out $75,000 or $80,000 a year, it's guaranteed for the rest of your life, no matter how long you live, no matter what happens in the market. So when you look at the withdrawal rates or the distribution rates, that's where the annuity is much more efficient. It's much more cost effective, right? Because dollar for dollar, you're getting an 8% payout rate instead of 4, right? Huge, guys. Absolutely huge. There was an economist and financial advisor, and now he's an author and coach. His name is Tom Hegna. He says that you actually cannot retire in the optimal manner without using an annuity. And the reason for that is he says that you are either going to do one of two things. Number one, if it's all in stocks and bonds and in savings, number one, you're going to spend too much and you're going to run out of money. Or number two, you're not going to spend enough. You're going to leave too much money on, but by not spending enough, that means you're going to cheat yourself out of the retirement that you could have and should have had, right? But with money into an annuity, guess what? You're spending the perfect amount of money because annuities are based on mortality and actuarial science. When you put money into an annuity, it gives you the exact amount of money. And again, what an annuity does is as you're spending your capital down, it usually is going to hit zero around average mortality age. But that's the thing. People are living longer and longer. And if you end up living past that, guess what? Now you're spending the insurance company's money from the risk pool, right? So that's actuarial science. Those are mortality credits right there. So if you implement an annuity, that's the optimal way to retire as far as creating your retirement income, right? And again, guys, these index annuities, they do have a fee to create this lifetime income rider. Again, it's usually 1 to 1.2%, and you're essentially paying for the privilege of turning your account into a personal pension. Again, meaning that even if you spend your capital down to zero, the income keeps coming. The insurance company is paying you from the risk pool. Okay. Again, a lot of people find that to be really amazing. You mean you tell me I can run out of money, but I can never run out of income? Yep, that's how annuities work. Again, they function like a pension. All you're doing is you're buying or funding your own personal pension when you utilize this strategy. Now, for that's huge for retirees because for many people, again, running out of money is their number one biggest fear in retirement. And for people who haven't saved enough and they are at the risk of running out of money, an annuity is a great idea because it gives them a hedge against outliving their money, right? And psychologically, investing is really difficult for most people. But when you're holding one of these annuities, it's like if the S&P 500 is up 10%, you get a portion of that. You still have some good upside potential, but when it goes down 20%, you don't lose a dime. And your income is unaffected. And that's really attractive to a lot of people, at least with a portion of their money. And then with an income annuity, again, the type that we're talking about, that functions like the personal pension. When the market goes down 20%, like if your personal pension is $5,000 a month, if the market drops 20%, if you have a variable annuity, yeah, your variable annuity can go down, but that's not what we're using. We're using guaranteed income annuities to create an income floor. So if you have a $5,000 a month pension that's getting paid out from this annuity, market goes down 20%, you don't lose a dime. You're still getting $5,000 a month, regardless of how long the market takes to recover, right? And that's why we put up this study from Wharton University, the business school out there. They published this just a couple of years ago, why retirement gets better with annuities. And it comes back to that behavioral finance, that no matter what happens in the market, no matter how long you live, the annuity provides certainty. It provides peace of mind. It provides guarantees, because people who have only variable assets like stocks and bonds, they tend to underspend, right? Most of these folks live a just in case or a what if retirement. What if the economy crashes? What if there's a stock market downturn? What if I live into my 90s? And so they're very cautious with their spending, and they don't spend their money, 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 and then they die. And then what happens to the money? The money goes to the kids, and the kids spend the money. So it's the kids who buy the boat. It's the kids who take the cruise. It's the kids who travel the world. And I'm not saying that leaving some money to your kids is a bad thing, but don't leave them all of it. This is your retirement, and I want you to enjoy it. And that's the thing when you're utilizing these annuities, like Wharton says, University of Wharton, that retirement gets better with annuities because it gives you an income floor and it lets you know exactly how much you can spend. So you can stop with the what ifs. You can stop this just in case scarcity mindset, and you can spend and enjoy your money and enjoy the retirement that you always dreamed of, right? But again, guys, just wrapping up here. If you have an annuity as part of your plan, you can freely spend the money from the annuity and not touch your stocks, especially during a downturn, right? Which will allow your portfolio to recover and come back. But here's the key. Don't just go buy an annuity, right? Run a financial plan. Run a financial plan and see how it fits and how much you should put in there. So, conclusion, don't be afraid of annuities. They are good things as long as they're implemented properly as part of an actual financial plan, depending on your overall strategy. But if the person selling the annuity to you, if they don't know about your savings, they don't know about your goals, they don't know about your overall planning, do not buy an annuity from them, right? You guys, we have a free guide. We have a ton of free educational content that's out there. But if you want to improve your financial life, you have to take action. And that first step is booking a complimentary consultation. So, for those of you who want to explore this with me in a personalized way, reach out to us. Again, you can reach out to us on our website, www.snellerfinancial.com. You can give us a call at the office, 248-499-9676. You could also email me, which I don't know if we have the banner for that, but ron@snellerfinancial.com. Again, we're happy to have that complimentary consultation and then run an analysis and give you our best interest recommendations. Looking here, what is the biggest challenge that you see for people planning retirement? I would say number one biggest challenge is that people know how much money they have. They just have no idea what to expect from that money as far as creating retirement income. Because for the last 30 or 40 years, people, they've been savers, they've been investors, they've been disciplined. They're putting money into their 401ks, into their IRAs, into their cash value insurance, into their investment portfolios. They've been accumulating money. But on the day that you retire, the game changes. All the rules change completely because it's no longer about accumulation. It's about preservation and distribution, taking this lump sum balance and turning it into retirement income. And that's a completely different set of rules, right? And so with these people, that's why I specialize in the retirement income planning arena, because these folks, you have to start dealing with things that you've never had to worry about before, such as filing for Medicare and when should you take your Social Security, taking retirement income through stock market ups and downs, and planning for long-term care, and tax planning, making sure that your retirement income plan is tax efficient so you can hold on to as much of the money as possible that you've earned, right, through legal means and good tax planning, right? So again, in that stage, it's all about taking income, and I find that the average person is really, really uninformed on how that works and some of the shifts in their strategy and their financial planning. All right, next question. If the market averages 8% per year, shouldn't I be able to take out 8% per year? So I'm assuming this question came from us talking about the 4% safe withdrawal rate earlier. And when we teach our retirement planning classes, I like to use this and kind of bait the class. Like I'll set a trap for them and I'll ask kind of like the same thing. If the market averages 8%, shouldn't I be able to take out 8% per year? And shouldn't I actually be able to preserve my portfolio? I'm just spending profits, right? And people think about it like, yeah, that makes sense, right? But that's where you need to start looking at some of this nuance here, right? So the question I'd ask them, number one, is does the market go up 8% every year? And they think about like, no, it's all over the place, right? It might go up 6%, it might go up 15%. But then the next question is, does the market ever go down? It's like, oh, yeah. Just a few years ago, the market lost 25%. You look over the last 25 years, the market's lost 50% on two separate occasions during the dot-com crash and during the great financial crisis. So my question to you is, as the market's falling 50%, and let's say that it falls over the course of 3 years and it takes 3 or 4 years to recover, but guess what? You're pulling money out of your portfolio and you're accelerating the downward spiral during that time, right? That's one of these big mental shifts from accumulation into distribution, right? If the market is falling as you're accumulating money and you're contributing to your 401k, it might suck to watch your 401k go down 30%, but the new money going in is buying new shares of stocks at a 30% discount, right? And then over time, that market should recover over time. That should actually help your performance. And that's called dollar cost averaging. But in retirement, it doesn't work like that anymore because you're not putting money in. In fact, you're taking money out. So what happens if the market's down 30% and you're taking money out? What that means is you have to sell shares of stock at a 30% loss, and you're locking in that 30% loss. And in order to create whatever income that you need, you actually, because the shares are lower, you actually need to sell more shares at that loss, lock in those losses, which just accelerates the downward spiral on your portfolio. And if you go into a steep bear market where it's 40 or 50%, or it lasts a long time, 3, 4, 5 years, or it takes 4 or 5 years to recover, that's where you start seeing this acceleration into the downward death spiral that you may never be able to recover from. So again, on the surface, yeah, if the market averages 8%, I should be able to take out 8% a year without even dipping into my principal. But that's just on the surface. When you actually dig into it and learn about how this stuff actually works, that's called sequence of returns risk, by the way. And the financial services industry has already studied the data on this. So if you want to stay safe, any money invested in stocks and bonds, you should only take out 4% of your starting portfolio balance. Next question. Why do you focus on income more than average rates of return? This is just kind of going back, I think, to this question of the different strategies that you're going to have in the accumulation phase of your life versus the distribution phase of your life. Because during the accumulation phase of your life, averages do matter, right? You want to have the best average rate of return that you can. But in retirement, average rates of return don't mean a damn thing. And what I mean by that is if you retire and you retire into a bear market, in the first few years of your retirement, the market goes down 30%, and you're spending into that bear market and you're accelerating that downward spiral, and within a couple of years, your $1,000,000 is down to $500,000, you're toast. You're never going to be able to recover, because even when the market does go up, you're not making interest on $1,000,000 anymore. You're making interest on only $500,000, and you're still taking distributions because you can't just stop living in retirement. You still need the income, right? So again, average rates of return, it does matter in the accumulation phase of your life, but it does not matter in the retirement phase of your life. What matters much more is the order in which you receive those returns. If you have if you have a bad market return early in retirement, that's going to be really challenging. And that's nothing that you or I can control. Like, the market's just going to do what the market's going to do. But the one caveat I'll say to that is that with my clients, where we use these annuities, where we take a portion of the money from their 401k or IRA, we do a rollover into one of these guaranteed income annuities, and it creates a pension. And so the annuity pension, it's removing the strain on the investment portfolio to create the retirement income. I have a lot of clients who have money on the side in their investment portfolio where they're maybe only spending 3% annually, or sometimes not at all. They just dip into it every so often for discretionary expenses. So if we're not relying heavily on the portfolio to produce retirement income, guess what? We're still focused on growing that money. And in that case, we are still focused on average rates of return. It really just depends on how your finances are structured as you transition into retirement. Any other questions, Ashlyn? Oh, yes. Yes. So aren't income annuities going to lose purchasing power to inflation over time? Because like pensions, income annuities are a set amount. They're guaranteed for life and they're locked in. And so what happens if I live into like my late 80s or live into my 90s? Isn't inflation going to erode the purchasing power of my annuity? And the answer is yes, but also no. And here's what I mean by that. When is a person going to spend the most money in their retirement? Is their spending going to be the most aggressive when they're 65 or when they're 85? And obviously it's when they're 65, right? It's at the point where they're youngest, healthiest. They have the most, vitality and energy to go out and do all the things on their bucket list, or what they think about, as their dream retirement in their golden years, right? By the time they're 85, they will have slowed down significantly. And maybe the majority of their day, they're sitting in a rocking chair with their great grandkids on their lap or something like that, right? So they're going to need much less income, right? And so what this strategy does, the income annuity is going to front load spending in retirement, or front load the income into the beginning of your retirement, so you can spend a ton of money and do it very safely, whether the market's doing what we want it to do or not, because that's when you're going to spend the most money, right? Because for each person, and it's going to be a little different depending on your health and your genetics and family history, but for each person, they're going to slow down with age. And at some point, their spending falls off a cliff. What most surveys and research shows us is that's around age 75. So if you retire at age 65, you've got 10, maybe 12 years where you're going to be active in spending money. And then at some point, your spending falls off a cliff. So my point is this: you do not need inflation protection on your entire income for your whole life, because the discretionary expenses at some point, they're going to stop or they're going to go down significantly. However, with that said, there are some expenses where the inflation doesn't go away. Food, gasoline, electric, utilities, insurance, property taxes, things of that nature. So it's not like we're just ignoring inflation altogether, because I've never suggested anybody put all of their money into an income annuity. You got to remember, we've still got an investment portfolio on the side. So if somebody has put $200,000 into an income annuity to secure their pension, they may have another $300,000 or $400,000 like sitting on the side that we can use to offset the effects of inflation over time for those items where inflation will continue to rear its ugly head. What about liquidity? I've heard that you give up control when you move money to an annuity. Well, let's think about liquidity and what an annuity is designed to do versus what it's not designed to do. I've heard critics of annuities say this here, and it's almost like they're trying to do a gotcha. And on the surface, it kind of makes sense. But again, when you look at it with more nuance, you see that this argument really doesn't hold weight, right? Again, we're using annuities for a very specific purpose, and that's to create a guaranteed income stream. Is anybody going to tell me that they don't want Social Security because it's not liquid and they've given up control? They don't have control of that money? No. Are you going to tell me that you don't want your pension anymore because you don't have control or that money's not that liquid as a lump sum? No, right? The only problem, or the only time that the liquidity would be a problem with an annuity, is if the advisor tells you to put all your money into an annuity. And I'm not doing that. And I doubt anybody's really doing that. But that would be the only issue where liquidity, or the only time where liquidity would become an issue, because we've still got plenty of money, cash in the bank for like an emergency fund. And we've still got plenty of money in their investment portfolio, right? Even kind of on the high end with the annuities, the most I've really done is I had one gentleman who wanted to put 50% of his money into an annuity. So we did, but he's still got 50% of his money in the investment portfolio readily liquid in case he needs it, right? So I would say that this like giving up control or this liquidity thing, again, it's overblown by critics. I think it's something you need to ask, and you need to make sure, again, that the balance is correct, that you're putting the proper amount of money into an annuity for your specific goals, and that you're keeping the proper amount as liquid cash in the bank, and then the proper amount invested in our portfolio as well. Yeah. And that should do it. I don't think that we have any other questions, Ashlyn. She's shaking her head no at me. And again, guys, I hope this was helpful. Thanks again. Take care.